All right, so today is Monday, October 31st. Again, happy Halloween. Today, this class is being recorded, by the way. Today, what we're going to do is we're going to pick up exactly where we left off with your homework 8 valuation model for Costco, and we're going to continue building it. So you need to basically have that file open and ready to go. We're also going to be using Bloomberg today, so you might want to be logged into the terminal as well, so that the screenshots that I take, you can see exactly what we're going to be doing. Okay? So just conceptually, this is the file which we finished last week, which you've turned in for your homework assignment. And essentially what we did is we took historical financial statements for Costco, we created a forecast for the next 6 years, and we turned them into economic statements. So we have forecasted economic statements, which included forecast cash flows under the CFI. Today, we're going to turn that into a valuation, okay? Or also as a discounted cash flow or DCF valuation. So to do an enterprise DCF valuation, we're going to follow Modigliani-Miller. So the whole idea is that operating value plus non-operating value equals enterprise value, and that's going to equal the debt and equity value of the firm. Okay? So if we take the operating plus non-operating value as enterprise value minus the debt, we're left with the equity value divided by share price. So it's actually a very straightforward process to do the valuation now that we have converted and forecasted the statements. Okay? So that's what we're going to pick up. So in our model, we're going to add a new worksheet at the very end, or a new tab. So add a plus here. And we're going to call it the valuation tab. And I want it to be the last tab in my model, so I'm going to move this worksheet to the end. And make it a little bigger so that we can see. All right, so following Modigliani-Miller, our first step is to look at the operating value for Costco that we have forecasted, right? But there was one other important thing that we forgot to do last week that we also need to do for our model. Anytime you import model data, column H is the last historical year. Notice that the last historical year for Costco is actually 2022, okay? Because their fiscal year ends in August. It doesn't end in December, okay? So for them, they're actually in 2023 already. Our model says, under assumptions, the last reported year was 2021. So we need to change that to 2022. Because our first forecast year, you can see this under CFI, column H, is actually 2023 to keep up and be in sync with the company, right? So number one, this is why we use a dynamic model. We can change the assumptions, flows through, but we also got to pay attention when we upload data to see if things like this change. Because if you have a non-standard year, you're in the middle of the year, you're like, oh, they're still in 2022. No, they're not. Retailers don't use standard years. So in this case, Costco's already in 2023. So we have to adjust that as well. Okay, something we didn't do last week. Not going to ding you on the homework because I forgot to mention that to you. But for this assignment going forward, make sure you always check that year when you enter in a new company's data. Okay? All right. So with Costco, back to the CFI, we're going to start out by doing the operating value. Operating value is based on free cash flow. On the CFI, we have a forecast for free cash flow. That is row 14, starting in first forecast year H, which is 2023, all the way through M, which is 2028. Okay? So essentially, we're going to take those free cash flows and we're going to put them onto our DCF tab. Okay? So the valuation, our first forecast year, and I'll make this a reference, B1, or sorry, this is going to be free cash flow. And B1. Our first forecast year, I'm going to put in A2, equals, from the CFI, just so we have the relative years, H2, 2023. That's my first year. Okay? Now, when we did the forecast, we actually forecasted 6 years. I mentioned this last week, that you always forecast an extra year, an N+1 or a T+1 year, which is your perpetuity period. So the first 5 years are the year-by-year forecast. Year 6 is the continuing value or terminal value period. Okay? So we're going to take the first 5 years from the CFI of the free cash flows. We're going to put them in the valuation tab. Okay? Now I'm going to actually go down the rows as opposed to across the columns, so we can print this out in an 8.5 by 11 sheet of paper. Okay? So next year equals 2023 plus 1, and going all the way down, copy, paste to 2027. Okay? And so now I'm just going to transpose the numbers. So our forecast right now for 2023 free cash flow, cell B2 equals from the CFI. Free cash flow is row 14. 2023 is column H, so H14. And I'm going to make all of these one decimal place just to be consistent. 3,300.8. For 2024 free cash flow, B3 equals from the CFI. That would be I14. For 2025 from the CFI, J14. For 2026 from the CFI, K14. And for 2027 from the CFI, L14. So those are the first 5 years of forecasted free cash flows, assuming those ratios come true that we put in last week. Okay? Now, I need these to be in present value, okay? Because we're doing the DCF as of today, okay? Not over time. So I got to discount these back to the present, right? 2 options. I'm going to use the concept of discount factors. If you want to use the Excel present value function, have at it. But generally what we're going to do is we're going to take our free cash flow, we're going to multiply that by the discount factor, and that's going to get us our discounted free cash flow. Because we know that the formula for present value is cash flow divided by 1, cash flow divided by 1 plus R to the n. Okay? So we also know that cash flow times 1 over 1 plus R to the n or t is the same formula. Okay? So that's the point. That's the discount factor. Discount factor is just taking 1 divided by 1 plus R to the n or t power. Okay? So that's what we're going to do here for 2023. So equals 1 divided by, left paren, 1 plus R, and the R is our WACC. So off of our assumptions tab, we're using a WACC in cell B4, right paren. There's again, not B40, B4. Okay, so here's the point. I'm going to copy this down. So I also need to make sure that this always refers to cell B4 on the assumption. So $B, $4. And I'll just get rid of a few decimal places, make it easier to see. Okay. So I'm going to copy and paste this down to row C6. Okay. Now here's the point. Discounted free cash flow equals the free cash flow, which is B2, times the discount factor, which is C2. So the present value would be 3050.6. Again, I'll get this down to 1 decimal place just to be consistent. All right. Now, in the second year, the discount factor is 1 divided by 1 plus R to the n, so it's 1 divided by 1 plus R squared. Okay. So in the second year, when I copied it down at the end, add shift 6, which is the caret 2 for squared. In the third year, so edit cell C4, at the end, shift 6, 3. In the fourth year, at the end, add a shift 6, 4. And for the fifth year, a shift 6, 5. So that my discounted free cash flow, which is B times C, copy that down, those are the present values of those free cash flows. Yes?
Can you show what you did again? So I just type free cash flow.
Just multiply column B times column C, B2 times C2, or B3 times C3, etc. Just copy and paste that down. Okay? So here's the point. If I add these up, this is the operating value in the first 5 years for Costco, assuming our assumptions come true. So add up these 5 from D2 through D6. So basically we're saying that Costco is going to generate about 17.562 or 17,562.9 million of cash flow value in the first 5 years, assuming our assumptions come true. Okay? But that's the point. Costco's not done in 5 years, not like they go away. And so as the book talks about, as we talked about, the assumption is that companies last forever. Okay? Whether they're going to last forever, we don't know. But when year 6, which is where the continuing value perpetuity period starts, that's where we're going to use the perpetuity period for the forever part of the company. Right? And so in this case, that's why we also forecasted that 6th year, that T plus 1 or N plus 1 year in our valuation model, right? In that cell, we want to do so I'll do this in row 9, a continuing value. Okay. And we're going to put this in B9. And what we're going to put into B9 is the perpetuity value of the firm, which we're going to use a growing perpetuity, aka the key value driver equation. Okay? So if we go back to our lecture notes or the book, that would be that formula right there. Okay? So that's the formula we're going to use for the continuing value period. Okay? So just so we all see what we're going to do, I'm going to take a screenshot of that. And I'm going to put it right here in our Excel file as a reminder of what we're about to do. So our goal is to take that formula and put it into this cell, B9. Okay? Now, on this tab, you don't see any yellow. So I don't want to start directly entering numbers on this tab. So what I'm going to do is I'm going to actually build the 4 elements of this formula off of the assumptions tab. Okay? So going back to the assumptions, I'll make this a little bit bigger so it's just easier to see. All right? We already have a WACC. So now I need the other 3 parts of this. I need an expected NOPLAT. I need a G, and I need an expected ROIC. Those are the other 3 elements of the formula that I need to finish off key value drivers beyond the WACC. I'll make those yellow. Okay? So where am I going to get these starting assumptions? Well, for my expected NOPLAT, what I'm going to do is we have a forecast for NOPLAT off of TII. It's right here, row 5. So I'm going to use the perpetuity value, which is column M, NOPLAT, as my starting point. Okay? That's my expected profit in year 6. So, valuation, assumptions, equals, from the TII, M5. And again, just to be consistent, I'll make this 1 decimal place. All right, G, I'm going to use 3%. Well, you're probably thinking, like, where'd that number come from? Generally, we're going to assume that when a company hits maturity, Costco is probably pretty mature, that they tend to grow about the economy. And I know we're in a really tough economic environment right now in the U.S., but long term, we generally grow 2 to 3% a year. That's the expectation for the long-term growth rate when things normalize out. So at this point, I'm going to use 3%. Some people might argue 2% is more realistic for the future, but right now it's just a placeholder. We're going to put in 3%. Okay? And then our third assumption is we need an expected ROIC. In our economic profit tab, we have a forecast for ROIC. It is right here after goodwill, row 16. Right? So again, the number we care about is the perpetuity period, so M16. That's what we're going to use as our starting perpetuity ROIC. Okay? So back to assumptions, equals from the economic profit tab, M16, which is 26.5% right now. All right, based on these four assumptions, we're going to create the continuing value for Costco. So basically putting in that formula with the correct order of operations. So in cell B9 in the valuation tab, equals, left parentheses, and I'm going to just build out that formula off of assumptions. So the expected NOPLAT, which is B5, times left parentheses, 1 minus the growth, which is B6, divided by the ROIC, which is B7, right paren, divided by left paren, the WACC, which is B4, minus the G, which is B6, right paren, enter. So 242 billion, 243.1 million. Okay. So all we did is basically put that formula in that cell with the correct order of operations. Right? And so that got us essentially a continuing value. Right? Now that continuing value, that perpetuity, actually discounts it to the beginning of year 6. Right? But our valuation is today. Right? So we actually have to discount that perpetuity value to today. Okay? So the perpetuity discounts the current year. So this is basically a continuing value as of January 1st. Okay? So it includes that year. Now, January 1st and December 31st, for all intents and purposes, are the same value. So we have to bring that back to today, which means we have to bring it back 5 more years. So we're going to use the same discount factor as we did for 2027. Common error, don't double discount that year in the perpetuity period. The reason why, as I said, is because the growing perpetuity formula includes a discount factor. Okay? So therefore, it's already discounted the year 2028. Okay? So you don't want to double discount that year. That's why we're using the same discount factor as the previous year. All right? So back to this. If I take my continuing value, present value that, I get 163,348.5 million. That is the continuing value for Costco, year 6 going forward. You'll notice that's most of the value of the firm. Like the first 5 years are pretty trivial. It's about 18 billion, and then I got 163 billion continuing value. That's the more important part of the valuation. But if I add the two together, I get the operating value of the firm. So that's the first 5 years. Plus the continuing value. 189.11.4. Yeah, get it back down to 1 decimal place. All right, so very quickly, we have estimated the operating value for Costco going forward. Okay? Operating value plus non-operating value equals enterprise value. Here's where our converted TFI helps us. On the TFI, which again I'll make a little bit bigger, we have listed and broken out the non-operating items, rows 10, 11, and 12. Excess cash, non-operating liabilities, and non-operating assets netted, and then long-term investments and long-term receivables from our standardized statement. Okay? So basically, I need to add those 3 things in, the values for each of those, into the non-operating value. Okay? So starting with A13 on the valuation equals from my TFI, starting with excess cash, which is A10, and then going down A11, A12, matching those three numbers. Now here's the deal. I don't invest in Costco because they do random things. I invest in Costco because they're a really good discounted retailer. Okay? So the assumption we make about non-operating value is that companies are generally not good at running non-operating assets, right? Because by definition they're non-operating. So all future non-operating asset values are NPV 0. We'll assume you earn your cost of capital on non-operating assets, right? But you're generally not going to earn more than that. Now again, we could always override these assumptions, but that's just a reasonable proxy that most people use. So the real value is driven by the operating value plus the current value of the non-operating assets. So that's the point. We're going to use the current value of non-operating assets. They have a value, but they're just not going to grow over time like the operating free cash flows would. Right? So basically what that means is for cell D13, what we're going to do off of our TFI is we're going to use the current, so column G, ending 2022, values for each of those non-operating assets. So basically, valuation equals, for excess cash, off of TFI, G10, and then copy and paste down, 11 and 12. So those are the three, and I'll get to one decimal place again, non-operating asset current values for Costco. Okay. So if I add the three together, row 17, I get the non-operating value which is the sum of the three above, which is Costco's $8 billion, $4.9 billion. See what we just did? Okay. So if I take the operating and non-operating value together, add those, we get the enterprise value forecast for Costco. Enterprise value equals the operating value, 180.9, plus the non-op, about 8. So I get 188.916 billion of enterprise value. That's our enterprise value forecast. Now, following Modigliani-Miller, enterprise value also equals debt and equity, interest-bearing debt and equity. So if we subtract all the interest-bearing debt, we would get the equity value, right? And if we subtract all the non-common equity, the residual, what's left, would be the common equity value. All right, so that's what we're going to do. We're going to pay off all the other debt and equity stakeholders except for common, and we're going to solve for the common equity value because they're the residuals. They get what's left. Okay. Again, this is where TFI helps us because starting in row 21 equals from the TFI, the two debts we have on here are the retirement-related liabilities and the interest-bearing debt. Again, we've lumped short and long-term together in our standardized statement. Okay? Then the two equities that are non-common that we would have to pay back, because we're solving for the common equity, is preferred stock and minority interest. So those are the four stakeholders that would have to be paid back before we got a common equity value. Today, how much do we owe them? Well, that's our 2022 values. So for cell D21 equals from the TFI, current year is column G, debt, retirement liabilities, G15. And then G16 is the interest-bearing debt. Then we go skip one equals G18 is preferred stock. And G19 is minority shareholder interest. So if I were to add these up, make the one decimal place, again, just to be consistent. And subtract them, I would then get a common equity value, which equals the enterprise value minus the sum of those four. 179,388.3 million. Okay, questions about any of that? Make sense? Able to follow along on that? So pretty simple at this point. If I take the common equity value and I divide that by the shares outstanding, then I get a forecasted share price. Now, I don't want to put the shares outstanding on this tab directly. No yellow in this tab. Because I will guarantee if you hard code the share count for Costco in here, when you switch this to another company, you're going to forget to change the share count, and you'll be like, my model doesn't make any sense, right? Because you're going to have the wrong share count in there. That's why, again, we put the assumptions all into one place. So the next assumption down, even though one on that screen, is going to be the shares outstanding. And that's going to be yellow off the assumptions tab. So in order to get the shares outstanding, we're going to go to Bloomberg. There are 3 screenshots you are going to need for any company, and you're going to have to turn these screenshots in with every assignment. Okay? The first one is DES. So in Bloomberg for the company DES, take a screenshot. Save the screenshot. You're gonna need that screenshot, right? Now, I took the screenshot earlier today. 2 things we're gonna get off the DES. 1, the current share price, right? You're gonna do these valuations at different times when you work on your assignments. The share price on Wednesday is different than the share price on Friday. In fact, depending on the time of day on Wednesday, the share price is bouncing around. You can see it's doing it in real time right now. Okay, so we need to know what the share price is at the time of the valuation. The DES screenshot sets that share price. So when you take that screenshot, whatever it is at the top of your DES is the valuation that you're going to do for Costco or whatever company you do. Okay, so that's one reason you're taking the screenshot. Okay, second reason you're taking the screenshot is down here. This is the current shares outstanding for the company. Costco, 442.6 million. So we're also going to get the share count, current shares outstanding, from the DES. Just a quick and easy place to find it. So 442.6 million. 0.6. So basically on the valuation equals assumptions B8 and share price equals equity value divided by shares out, $405.31. So if everything came true in our model, we're saying Costco's worth $405.31. Okay? Now, Costco today is trading at 505 and change, right? So the next step is to make sure these 2 numbers match. That whatever we're forecasting in our model matches the real world share price at the time of the valuation. That is what we're going to call the as-is valuation. Nobody else does that. This is something unique to this class. Usually what people do is they go straight to the target. Here's what I think Costco's worth. We're going to do that. We're going to call that the target valuation. However, right, we're still going to do the as-is first. We're going to value the company at its current share price. Then we're going to put in our opinion of what we think it's going to be worth. That'll create the buy-sell hold. Okay? The reason why we do the as-is first is because we're going to work backwards to say what assumptions in the DCF must the market be using to get the current share price? We'll then change those assumptions to get our target share price. Okay? So rather than just randomly creating some assumptions that equal a target share price, I kind of want to know what assumptions justify the share price today. That's the whole point of the as is. It will help you when you do your target, because it'll put in some realistic baseline assumptions for the company. Right? So that's called the as is. Right? And it's not whether you agree with the current share price, because the share price is the share price. It's observed in the market today. What assumptions in the DCF lead to that share price? That's what we're going to put in here. And the standard in matching is within $1. Okay? So for your as is this semester, you must turn in a spreadsheet within $1 of the current share price at the time of the valuation. If you're outside of that dollar at either end of the range, plus or minus, you'll get a 0 on the assignment. Okay? Because you're not following the instructions. The instructions are to value the company at the current price. And if you don't value the current price, you didn't do an as is. Okay? Everybody clear on that one? So our goal is to value the company at the current price. Right? Now, you'll notice I didn't take a full screenshot here because this is the 9:30 a.m. section, and I had actually done this in the 8 a.m. section. And just so we're consistent for all 4 sections today, we're going to use the pre-market Costco share price, which I did at 8 a.m. today, as the as-is valuation. Okay? But if you were doing this for your homework, you would take the screenshot now and you would do it at 5:05:40. Okay? And again, if somebody did their homework tomorrow, then they might get a different share price, and you'd use whatever share price is at the time. Because that's the point. I got 172 students across 4 sections. You're not all doing the assignment at the exact same time, so you're going to have different share prices. So here's the point. You have to turn these screenshots in with the valuation so that when we grade you, we can sync up with where you did the valuation at the time of the market. So without the screenshots, you can't get credit for the valuation because otherwise we don't know how you sunk up. Okay? So 2 things. 1, there are 3 screenshots. This is the first one that you always want to turn in with every assignment. 2, you're going to turn in 4 Excel models with every assignment. Okay? You're going to do an as is, you're going to do a target, and you're also going to do what's called a bull and a bear. Okay? Because when a Wall Street sell-side analyst gives a bank, from the bank, gives a fund a target, they don't just want to say, I think Costco's target share price is 520. They want to know upside downside. They want to know how high it can go in the next 12 months and how low it can go in the next 12 months. Because if you think about it, portfolio management is all about the standard deviation of your portfolio. So I need to know what it looks like for the company that I'm valuing. So we're going to also do an upside downside case called a bull and the bear for every company. We're going to talk about the reasons for the upside and the downside. And so that's going to be the papers that you're going to write, okay, coming up. Because you got to explain the assumptions for the upside, the assumptions for the downside, and the assumptions for the target valuation. That's what you're eventually going to be writing up in these valuations and describing when you do your group case. But for now, we're just going to do the as is here in class today, okay, and match the current share price. So this morning, when I took the screenshots, the DES was 510.80. And that was the current share price before the market opened, 510.80. Okay? So what I'm going to do is I'm going to come back here and under assumptions, current share price. What did I say, 510.80? Is that right? Okay, thank you. All right. Make that dollars yellow. All right. So I need my model, which right now is 405.31. As a matter of fact, I'm going to edit this cell. I'm going to call this the model share price, just so we don't get confused about which share price we're talking about. So I need my model share price to get within $1 of the current share price, okay, which is the forecast. Now, here's the point. How we're going to do this is we're going to go to the ratios, because these were placeholder ratios. So we're going to now adjust the ratios to change the price, right? And every time we change the ratio, the price of the model will adjust. Now, here's the other thing. It is annoying that every time you change the ratio, you got to go look at the valuation tab to see how it changed. So what we're also going to do on the ratios tab, make our lives a little bit easier, is down here near the bottom, again, I'll make it slightly bigger, is I'm going to put in equals from the assumptions, the current share price, not yellow, because I'm referencing it, and the row below equals, from the valuation tab, the model share price, and then that is the 405.31. So that way, I'll format that similarly. I have both right here, but you're not yellow here because I didn't enter it here. I entered one off the assumptions tab. I calculated one off the valuation model. I'm just putting them side by side so that every time I change a ratio, the share price will change. So right now we're about to adjust the ratios. Okay. Again, questions about anything we've done so far? All right. Now, these are all the yellow ratios they did change. The most important part of our valuation, you can see it here in the valuation tab, is almost of the enterprise value, almost all of it is the operating value. That's true for most companies. So the free cash flow is the most important part of the valuation. Okay? Secondly, free cash flow is gross cash flow, gross investment. Okay, I need both of those. So back to ratios. Here is where we have to forecast gross investment by forecasting balance sheets. All those ratios are a percentage of sales. If you remember last week, I said there were two reasons why we did everything as a percentage of sales in the model. And I said I'd get to the second reason later. This is later. The reason why all of these ratios are a percentage of sales, and this is the convenient part for us, is that when sales grow, the balance sheet grows. Because all those ratios are a percentage of sales. So we are automatically forecasting balance sheet when we grow sales. So that makes our lives a lot easier, right? So as long as the productivity stays about the same, we don't have to change these balance sheet ratios. And you'll see that that's what the invested capital to sales ratio is all about. Because you'll notice for Costco, the IC to sales doesn't change all that much historically. And that's true for most companies outside of acquisitions, is that their productivity tends to be fairly stable over time unless they're doing gigantic acquisitions. So the point is, unless the company's productivity is going to be dramatically different, we can leave these balance sheet ratios alone. Okay? So let's say a company's in terrible distress, has a huge amount of capacity, and stops buying plant for a few years. Well, maybe we'll change the balance sheet ratio. Okay? Or they're about to go on a gigantic expansion that they probably haven't been on. We can put that in the balance sheet ratios. But 80-20 rule, we can probably leave these balance sheet ratios alone most of the time. Now again, any of these ratios can always be changed if you think it's more appropriate, but this actually makes our life a whole lot easier. All right, everybody clear on what we're doing here? So we're leaving these alone. Right? So what we really need to forecast, because this will then forecast gross investment, because two different balance sheets equal gross investment, the changes. So the model will automatically calculate the gross investment forecast for you. Right? So that means we need gross cash flow. All right? Now here's the thing. These three cells are in light gray, and they were put in light gray for a reason, because those are the drivers of gross cash flow. Okay? So three things drive gross cash flow. Revenue growth rate, EBITDA margin, tax rate. Those are the three most important drivers to gross cash flow. So here's the point. This is the 80-20 of the model, or what I even call the 90-10 of the model, is that the most important things that you can forecast are those three items in gray. Revenue growth rate, EBITDA margin, and tax rate. Because the model will auto-forecast the DCF. Otherwise, because it will forecast gross investment. Questions about that? So that's what we're going to forecast next. We need more realistic numbers for those three gray rows, right? And we need a more realistic WACC. Okay, so screenshot number 2, we have a placeholder for WACC. We need to put in the current WACC. So we're going to go to Bloomberg, and we're going to type in WACC, hit enter, and then we're going to use that WACC as the WACC in our valuation. Screenshot number 2, save that, 8.7%. Again, I had done this early this morning. This is also even more important today because you can literally do Costco by Friday, and with interest rates going as crazy as they are in the real world today, that number may not be 8.7% on Friday. It could be 8.9%, right? So we're seeing big spikes in interest rates, and it's changing companies' WACCs. So we actually do need to check the WACC at the time of the valuation. It may be different even for one assignment, okay? So this is what we're syncing up to, 8.7. That didn't change since this morning. Notice when I go back to my ratios, share price went down. Now we've got a bigger gap that we got to close in our as-is valuation. Okay? All right, so in order to make things a little bit easier, so you can kind of see what I'm doing on the right, I'm going to hide, I don't suggest you do this, but I'm going to hide these 3 columns, not delete, hide, just so that you can see more of what's going on over on the right. Okay? All right, so I need to start changing these. The first one I want to change is tax rate. I need a realistic tax rate for Costco going forward. Again, back to Bloomberg. 2 areas I can find it. Number 1, sometimes companies will give guidance to the analysts doing exactly what we're doing with their models about what the tax rate's going to be. So in Bloomberg, you type in GUID, which is guidance, and see whether the company's providing guidance on the tax rate. In this case, Costco is. They're telling the analysts that their tax rate going forward is about 26%. Okay? So I'd be willing to bet most analysts are going to use about 26%. Right? So in this case, starting in our model, cell H10, 26%. Now, if the company, for some reason, doesn't have guidance for tax rate, we still need a forecasted tax rate. Option B. In Bloomberg, go to BRC. BRC is where we have access to the analyst reports. Now, we don't get all of the analyst reports, but we get some of the analyst reports. Okay, you got to pay for the analyst reports, right? But we get them from a few big companies, JP Morgan, Barclays, and Deutsche Bank, top 3 there. And those are very reputable analysts. And so here's the point. I can tell you that JP Morgan always puts the forecasted tax rate into their analyst reports, okay? Because the analysts are doing exactly what we are. So if you can't find the company guidance, look at an analyst report and then use that tax rate that the analyst is using in your model, okay? So for example, if I were to open up this JP Morgan report, which came out on, what it looks like, October 11th. You can even do a search here. Keyword search, tax rate. You'll see that JP Morgan typically puts a table of the forecast on here, and then in this table is the tax rate that they're using in their model. Trying to look and see where it is on here. There it is. Surprisingly, 26%. Okay, so again, 2 places to get it. All right. You don't need a screenshot for that, but that's where you're going to have to find the data. You got to get it right. All right, so next, we need a revenue growth rate, and we need an EBITDA margin. Okay, more realistic. Here's again, we're doing the exact same thing that they're trying to do in the real world for Costco. And there's some smarter people than we are about this industry out there that do this for a living. They actually put in their forecasts, because we're doing it as is, trying to figure out what the market's doing for Costco, into a screen which is summarized in EEO. That is the forecast the analysts have for Costco for the next 4 years in dollars. Forecast for revenue, forecast for EBITDA. If you go over to the second tab, that is the revenue growth rate forecast for the next 4 years. So because we're doing the as is, we can build on what the analysts are actually saying for the first 4 years. Now, we're not doing year 5, we're only doing the first 4, so we'll have kind of a stub year to worry about later, but at least we're going to kind of copy what the analysts are doing as the consensus for the first 4 years for growth rate and EBITDA margin. Okay, because they're already forecasting it. We're using the consensus, the baseline. Right? So, back to the headline, first tab, screenshot number 3. Take the screenshot, save the screenshot, Costco, forgot to do this earlier, EEO. Right. Now, I'm not going to ask you to take another screenshot for the growth rates because if you have the revenue, then you have the right growth rates. But nonetheless, you'll need to get the growth rates. So back to our model. What do we need? So on the assumptions tab, I'll go a couple rows down. And just to be consistent with the earlier class, I did this starting on row 11. Okay. So our first forecast year equals the current year plus 1. So it'll be for 2023. And then I'm doing 4 years, so equals that plus 1. And then two more years out. So forecasting through 2026. Okay? And the first line item is I need the revenue growth rate. Then I need the revenue. I need the EBITDA forecast. And then I'll have my EBITDA margin. These first 3 are yellow, directly typed in off the EEO screen. This I solve for, because EBITDA divided by revenue is the EBITDA margin. Okay? So, now again, I'm just transposing numbers. So starting for Costco revenue growth rate, first year, you can see actual 1, 2, 3, 4. These are the forecast years. 8.22%. So 7%. 5.9% growth. And 7.58% growth. That's what the market is expecting Costco today. Okay? If I translate that to dollars in 2023, the dollars of revenue turn out to be $245,600. $262,785. $278,277. $299,384. For EBITDA dollars for 23 through 26, it's going to be for 2023, 10,883. 11,938. 13,249. And 14,538. So that if I format this, and format this, just to be consistent, then my EBITDA margin equals my EBITDA. divided by the revenue. They're forecasting an EBITDA margin, which is not yellow, of 4.4%. Copy, paste, growing to 4.9% by 2026. So I have a revenue growth rate forecast, I get an EBITDA margin forecast for the first 4 years. So now what we're going to do is we're going to go back to our ratios, and I'm going to put these numbers in, except I'm not going to make them yellow anymore. So I'm going to unfill those, and I'm going to unfill those, because that is actually coming from the assumptions tab now. Okay? So for 2023 revenue growth rate equals, from the assumptions tab, B12. And then C, D, and E12, just copy and paste over. And then for EBITDA margin for 2023 equals, from the assumptions tab, B15. And then copy C, D, E, next 4 years. So basically, that would be the 4 years of growth and 4 years of EBITDA. By the way, share price is now $2.93. That actually went down again because we're not getting the growth. That was in the placeholders. Yes. Questions? Yes.
I'm sure the formula again for the EBITDA margin.
Formula for which one?
The EBITDA margin.
The EBITDA margin is just the EBITDA divided by the revenue. It's just the percentage. Any other questions? All right. So, what's left? We got the three kind of key items there. Now we got the perpetuity numbers, which kind of matter. But the other big number we have is the G. And obviously the market must be expecting a higher G because our target share price is not anywhere close to $500. Okay? So we'll start adjusting the G. Okay? So in this case, I'll say 6%. And that would be getting me to much closer. Okay, so it's probably more like, I don't know, 6.02 or 03. Try that. So if I get a 6.03%, then I'm probably getting close to my in one within $1. Now I'm 53 cents away. Okay. Now technically we could say, all right, we're close enough, we're within our $1, we're probably good, but how do we know we got that G right? Right? Because that's very important value. Because remember, when you look at your valuation, almost all that value is that continuing value of Costco. And so getting these numbers right, the ROIC and the G, is going to be very important. So let's just validate our ROIC. Does our ROIC look reasonable? Well, in the out years, our ROIC is not that different over the next 5 years. Given how stable Costco is, I think the ROIC is probably pretty close to what the market's using. So it probably is the G that's going to make a difference. But here's the thing, I want to make sure I got the G right. Right? Now, next week, we're going to talk more about getting G right, but here's how we're going to start. Okay? In the next section of the class, we're going to talk about multiples. And what you're going to realize is that all multiples are just the key value driver equation rearranged, and that multiples are an expression of growth in ROIC. So we're going to use real world trading multiples to help us validate the G and the ROIC assumptions. Okay? So looking ahead, in future readings in the book and a lecture note, this is in lecture note 6, I believe. This is future reading in the book, but the point is, here is the key value driver equation. We rearrange it, and we get the enterprise value to EBIT multiple. Here is the key value driver equation again. We rearrange it, and we get the enterprise value to revenue multiple. The key value driver equation rearranged is the PE multiple. There's a pattern. All the multiples, PE, enterprise value to sales, enterprise value to EBIT, enterprise value to EBITDA, they're all just the key value driver equation. Just rearrange math, right? And they are synced up with the DCF because we're using that for our DCF anyways, the continuing value. So that's the point. Like, if we know the company's multiple, kind of see that in the real world, then that will help us because we know how to solve for that to estimate a more realistic G. Okay? And so we also know here on this case that the enterprise value to revenue multiple is the margin times the enterprise value to EBIT. That margin is the EBIT margin, also as the operating margin. Therefore, we know that the operating margin is the enterprise value to revenue multiple divided by the enterprise value to EBIT multiple. Okay? So multiples help us figure out the perpetuity margin. Hiding in plain sight. So what I'm going to do in our valuation model and I'll take a screenshot just so you see what I'm doing. So I'm going to take this formula and I'm going to put this in as the other formula in our model. All right. Save this. All right. What cell did I start this in the other class, just so I'm being consistent? All right, row 17. So when we do multiples, one of the other things that you're going to learn is that forward multiples are more indicative of valuation than historical multiples. And the forward multiples that matter start in the second forward year. Because for Costco, the current forward year is dirty. What I mean by that is we're in November, basically, for all intents and purposes. So they finished their fiscal year in August. They now have 2 months, September and October, which are history, and they got 10 months worth of forecast. So at this point, for Costco, we got 2 actual and 10 forecasts. That's what I mean by a dirty year. Right? So we have a combination of actual and forecasted data. Next year, we'll have 12 months of clean forecast. What we tend to find is that multiples are more normalized against pure forecasts, as opposed to mix current data and forecasted data combined. Right? And they're more indicative than past multiples of real valuation. So translation in the EEO screen of Bloomberg, the other reason you're taking it, screenshot, it's down here at the bottom, are the current and forward multiples. So for example, the 2023 PE of Costco is the current share price, 502.40, divided by the 2023 earnings per share, 14.58, and that gets you a PE of 34.54. Okay? So Bloomberg is calculating forward multiples based on these earnings estimates. The two we're going to care about are enterprise value to revenue and enterprise value to EBIT. Okay? Because if I know those, I know the perpetuity margin. Okay? Back into that. Now I'm going to do this for 2 years. So I'm going to do it forward year 2 and forward year 3. Okay? The reason I'm using the second forward year, not the first forward year, is because the second forward year is the first clean 12 months of forecast. Okay? And what I want is I want the enterprise value to revenue multiple, or enterprise value to sales, interchangeable terms. And I want my enterprise value to EBIT, because that is going to get my estimated EBIT margin. So these two are yellow. That will solve for the number below. So for example, in the second forward year for Costco, and you can tell second forward year by just counting the columns. Actual, 1, 2, 3, 4. So forward year 2 is 2024. So the 2024 enterprise value to sales multiple for Costco, 0.84 right now. It's also why it's important to do the screenshots together, because if you do the DES one day and do the EEO a different day, the EEO is based on the current share price. So when the share price changes, those multiples change. All right, so you got to do the screenshots around the same time to keep the multiples in sync with your valuation. Okay. Now, for the second forward year, 0.80. EV to EBIT is 25.18. And, sorry, 2282, got the wrong year, 22.82 for the second forward year. And for the third forward year, 20.53. So equals enterprise value revenue divided by enterprise value to EBIT. So essentially, 3.7% and 3.9. That's what the market is using today for the perpetuity margins. Said another way, in the ratios, it's this row and that column. That number in perpetuity is either 3.7 or 3.9, depending on the multiple year, right? I think, given Costco, we're undervaluing them. It's probably closer to the 4, so it's probably the 3.9, not the 3.7. So I'm going to choose the 3.9 out of discretion. But I could choose one of those two numbers or even split the difference, but I'm going to say 3.9. Okay? So I need to make that number 3.9. But here's the problem. That's white. It's a formula. I can't break the formula. So I can't directly change that. But I can change it by changing one of the two numbers above, which lead to the EBIT. So what I'm going to do to make that 3.9 is I'm going to change my EBITDA to 4.8. Now, because of rounding, it didn't actually change, so I'm going to make it 4.7. That made that 3.9. So now I've matched the perpetuity value that the trading multiples are in. Okay. By the way, that put my model share price to 489. I need to get to 511. So that suggests that the G has to be a little bit higher. So this G is not going to be 6.03. It's going to be something like 6.15. 6.17. That's probably a more realistic G. All right, questions about what I did, how I did it, why I did it to get to this point? Now, there's one other thing which we will do next week, which is there is a formula in the ratios to do an enterprise value to EBIT multiple, EBIT and EBITDA multiple, so we can actually get a better G using that as well. But we're pretty close. So for purposes of this week's assignment, this is where you need to be. Okay, so this is what you got to match for half of your next homework. But homework 9 is a double feature. So I'm going to increase the points to 4. So it's 4% of your semester grade, not 2% of the semester grade. And this is half of homework 9, is to match the Costco model as is, just like this. Okay? That's half of homework 9. Here's the other half of homework 9. The other half of homework 9 is I'm going to give you a different company. And you're going to value an as-is of that different company as of today. Okay? Or at the time of the valuation. In your case, it'll probably be Wednesday. Right? So basically, you're going to have to update this model with another company's data to match their as-is. That'll be your other assignment for Monday. Now, you're not going to have to do a write-up on this upcoming assignment because you're just doing the as-is. Okay, but you're going to have to turn in 2 Excel files, and you're going to have to turn in 6 screenshots. The 3 screenshots for Costco, and the 3 screenshots for the company that I give you on Wednesday. Okay? And so basically, you'll do the as-is for that company using this file, going through the process that we just went through with this model, and you'll turn in all of that for your next Monday's assignment. Okay? So 2 final things. 1, because that's a lot, all right, to get done, we are not going to have a lecture on Wednesday. I'm giving you Wednesday as a Bloomberg lab in class day because you're going to need to get all that data. You're going to have to export the model data. Make sure you can find a computer that's not jammed up with data limits. We're now going to be after November 1st, so now the computer lab should be jammed. You should be able to get data on all these terminals on Wednesday. But get the data out for that company. I'll show you how to do that in just a second. And then what you're going to do is you're going to basically take the screenshots for that company, get the as-is to match within $1, and then turn in those files as well. Okay, that's going to be your next homework 9. Okay, so in order to do that, you're going to need this file. So just as an overview of the process, how do I update the Costco model, which I'm now going to rename the Costco as-is. Now next week, we'll come back next Monday, we're going to have a lecture. We're going to do both the bull, the bear, and the target. We're going to do all that next week. And then that's where the write-up comes in, because as you change the assumptions between those models, that's what you'll eventually be writing up. Okay? But for this week, we're just kind of building all the models. Just make sure technically you know how to do that. Right? And getting the assumptions into the model. So here's the point. Let's say we do another company. Okay? So what I would do is, first thing, I need let's say we were doing 443 spring Dollar General, which we did last semester. Okay? So the first thing you would do is you'd have to take Dollar General's data, export it as we talked about last week, select it, we're going back to Dollar General, copy it, come in here, model data, select pay special values, and update it with whatever company that I give you. Okay? So that'd be the first step. Second step is you go to the assumptions. What was the last reported year for the company that I just gave you? Type that, make sure that's the right number, because we have a 2022 for Costco. It might be 2021 last reported year for the company I give you. What is their WAC? Get the screenshot. Type in their screenshot. What is their G we're going to solve for? What is their shares outstanding? Go to the DES screen, update the share count. Otherwise, you're going to have trouble matching the valuations. What is their current share price? It won't be $5.10 a share. It's whatever company it is. Then from the EEO, what is their growth rate, revenue, and EBITDA dollars? All that should update. What is their trading multiple for EV to revenue and EV to EBIT? Put all that in. What is their tax rate? Because remember, this model has Costco's hard-coded numbers in it. What is their perpetuity EBITDA? Make sure you change that, because we just hard-coded that. It'll otherwise have 4.7% in, which could be a far different value than what you're doing. And then basically solve for the G. Okay? So essentially, that's what you're going to have to do on Wednesday or later this week for next Monday on company number 2. Right? TAs will have office hours. Matter of fact, one of the TAs just shifted his office hours to Wednesday. You can take advantage of that. Generally, I'm giving you class time on Wednesday so that you're all going to need to use the lab. So this is kind of like your lab time. You don't have to use the lab, but I'd strongly encourage you to do that. And so again, you're going to turn in those 8 files for next Monday's assignment. It's a double assignment. Okay, it's a big assignment. 1, match Costco with the 3 screenshots, as we did today. 2, take that file, put the new data for the other company, match their as-is. No write-up, just those files. Clear on what I'm asking you guys to do? All right, yes?
When you say soft reviews, that's just a place plugging in.
Just like we did. We're gonna basically back into the G that gets the share prices to eventually match, within $1 as a tolerance range. All right, last but not least, next week originally on the syllabus was the group projects. It's taking us a little longer to get to the group projects because we've got to get through the valuation. So I'll be pushing that back 2 weeks, okay, to give you time to kind of do some individual assignments and practice on this. But you are going to be doing evaluation on density, okay, as a group using this model. All right. See everybody on Monday. And then last but not least, where's the sign-in sheet? Make sure you sign that before you leave today. Otherwise, happy Halloween.
So I have one question. So the 3 screenshots